It's November 5th, 2024, Election Day. And we all know what that means, right? I mean, nail-biting anticipation and endless pendulary. And, you always have that question in the back of your mind. What will this election mean for our, wallets? Well, today we're diving into exactly that. We'll be exploring potential market shifts and tax implications so you can feel, informed and maybe even a little bit less stressed.
Yeah, it's really easy to get swept up in all the election frenzy. But I'm here to help you cut through all the noise and focus on what truly matters for your personal finances.
And that's where the Lakeshore Group of Raymond James comes in, right?
Absolutely.
I mean, they've got their finger on the pulse of the markets, and we're lucky to have you here to, break it all down for us.
Absolutely. Let's start with the elephant in the room. Market volatility. Election years always bring uncertainty, and the markets tend to react, sometimes dramatically.
So should we be bracing ourselves for a roller coaster, or is it all just hype?
Here's the thing. While we might see some short-term swings, history shows that the actual winner of the election rarely has a dramatic long-term impact on the market. And in fact, we are entering what's historically the strongest period for the market. And elections themselves can act as a catalyst for, upward movement.
Okay, so that's reassuring. So instead of panicking, maybe we should be looking for opportunities.
Exactly. And one of the smartest ways to position yourself, no matter who wins, is to understand the potential tax implications. Because, let's face it, no matter who's in office, taxes are a certainty.
Yeah, true enough. So let's break down the potential differences between a Trump administration and a Harris administration, especially regarding income tax.
Well, based on what we know, Trump would likely stick with the 2017 tax cuts and potentially even lower them further. This means if your income falls within those brackets that saw reductions, you could see continued tax savings under a second Trump term.
And what about a Harris presidency?
Harris has signaled a focus on taxing the ultra-wealthy and corporations, which could mean raising the top income tax rate. So if you're a high earner, you might see your tax burden increase.
Interesting. Now, for those of us with investments, what about capital gains tax? That's always a hot-button issue.
Absolutely. Harris has proposed a 28% capital gains tax for high earners, which is a significant jump from the current rate. Now, Trump hasn't laid out specific plans in this area, but it's something to keep an eye on. Depending on your portfolio and how much you rely on investment income, this change could be a game changer.
Okay, so income tax and capital gains are definitely on the radar. What other tax areas should we be paying attention to?
Corporate tax is another big one. Trump aims to decrease it further, possibly to as low as 15%. Harris, on the other hand, is more likely to maintain the current rate. These decisions can have ripple effects on the economy and ultimately impact your investments.
Makes sense. And then there's the estate tax, which, let's be honest, is something many of us don't think about until later in life, but it's important.
You're right. The current exclusion is nearly $14 million, which Trump would likely maintain. But Harris has proposed lowering it to $3.5 million. If your assets exceed that threshold, this potential change is something you need to factor into your estate planning.
Yeah, that's a huge difference. It really highlights how crucial it is to understand your personal financial situation and how these potential policy shifts could impact you.
Exactly. And don't forget about child tax credits and deductions. Both candidates have expressed support for expanding these programs, which could benefit many families.
So we've got a lot to consider on the tax front, but rather than getting bogged down in hypotheticals, let's shift gears and talk about sectors with potential for growth, regardless of who wins.
That's a great idea. Focusing on specific sectors rather than trying to predict the election's outcome can be a smart way to approach investing in an election year.
Okay, let's start with energy. What's the outlook there?
Well, we're seeing a trend toward deglobalization and onshoring, meaning there's a push to bring manufacturing and production back to the U.S. This is expected to lead to increased domestic energy production, which could benefit the energy sector.
So for investors interested in this space, you might consider exploring companies involved in like oil and gas production or those focused on fracking and permitting. It's all about aligning your investments with these, larger economic trends.
Exactly. Now, another sector with potential is critical minerals.
Ah, those essential components for all sorts of technologies like batteries and computing and even defense systems.
Precisely. And with the focus on onshoring and securing critical supply chains, demand for these minerals is only expected to rise. This sector could be particularly attractive for investors seeking to capitalize on the increasing importance of these materials.
Now we can't forget about AI. We've all seen how well AI-related stocks have been performing, and that momentum is unlikely to slow down anytime soon.
You're right, the AI revolution continues, presenting potential investment opportunities. You might consider exploring AI chip manufacturers like NVIDIA who stand to benefit regardless of which candidate's AI policies prevail.
That's a great point. So even within a sector like AI, we can find areas that are less sensitive to, election outcomes.
Exactly. Diversification is key, and understanding sector-specific trends can help you make more informed investment decisions.
Now, speaking of diversification, we can't leave out semiconductors. They're crucial for various technologies, and just like critical minerals, those onshoring efforts are expected to boost domestic production.
This sector could be of interest to investors seeking exposure to companies involved in the manufacturing and development of semiconductors. The demand is only going up, especially with the rise of technologies like 5G, the Internet of Things, and artificial intelligence.
Okay, so we've covered some exciting sector opportunities, but let's shift gears again and talk about something that's on everyone's mind. Interest rates, they impact everything from, mortgage rates to investment returns, so let's hear your take on the current rate outlook.
The Federal Reserve is expected to continue cutting rates, but perhaps at a slower pace than initially anticipated.
What's causing this slowdown?
Well, recent economic data has been surprisingly positive, which might make the Fed tap the brakes a bit. We've seen strong job growth, consumer spending remains robust, and, inflation is relatively tame.
So what does this all mean for us as investors? What should we be watching for?
The bond market is one to watch closely, as interest charges on government debt are a significant expenditure. Locking in current bond rates could be a strategic move right now, especially if you're concerned about rates rising in the future.
Got it. So we've talked about potential election impacts, promising sectors, and the rate outlook. But now let's get into some specific actions we can take to optimize our financial situation, especially as we approach, year end. After all, being proactive is key, right?
Absolutely. And one of the most important areas to focus on is year-end tax planning. There are so many strategies you can leverage to minimize your tax liability and potentially save thousands of dollars.
And that's where your expertise comes in, right? You guide clients through this process every year, making sure they're, taking advantage of every possible opportunity.
That's right. We use a comprehensive guide to spark conversations and ensure no stone is left unturned. It covers a wide range of strategies, from maximizing contributions to retirement plans to exploring potential tax benefits associated with gifting stock.
Can you give us some specific examples? What are some of the top strategies you recommend?
One of the most powerful tools is the Health Savings Account, or HSA. These accounts allow you to maximize contributions for tax-free healthcare spending, and any unused funds can be invested for, potential growth.
Okay, so we're talking about a triple benefit here: tax savings, healthcare coverage, and potential investment growth. What's not to love? What's the annual contribution limit?
For families, it's currently $8,550. Even if you can't contribute the full amount, consistent contributions over time can have a significant impact. It's like having a secret weapon for healthcare costs in retirement.
That's a great point. What other strategies should we have on our radar?
Education savings accounts, or 529s, are another great option. Funding these can lead to potential state tax deductions, so it's definitely worth exploring, especially if you have children or grandchildren headed to college.
Right. And don't forget about the potential tax benefits of gifting stock, especially if you have assets that have experienced significant growth.
Exactly. I had a client who gifted stock in a private company to their children. They benefited from an illiquidity discount, and the asset saw substantial growth. It was a win-win situation for both the client and their heirs.
Wow, that's an incredible story. It really highlights the power of, strategic gifting. Now, when it comes to retirement plans, what are some key things to keep in mind?
Maximizing your contributions is essential, of course, but it's equally important to ensure your plan is efficient. That means paying attention to fees, understanding how the plan is governed, and ensuring strong employee participation if it's a, company-sponsored plan.
So it's not just about contributing, it's about making sure your money is working hard for you.
Exactly. Now, let's delve into a particularly interesting strategy that many people are using to potentially boost their after-tax returns: direct indexing.
I've heard a bit about this, but honestly, it sounds a bit complicated. Can you break it down for us?
Think of it as a modern approach to passive investing, but with potential tax advantages compared to traditional ETFs or index mutual funds. Imagine you've held Apple stock for years and it's skyrocketed. Direct indexing lets you sell a portion, offsetting the capital gains with losses from another stock in the S&P 500, all while maintaining your overall market exposure.
Okay, that makes sense. So instead of being locked into a traditional index fund, you have more control and flexibility with direct indexing.
Precisely. You're investing in a separately managed account that holds the underlying securities of an index, like the S&P 500. But here's the key difference. Portfolio managers actively harvest tax losses by selling underperforming stocks and replacing them with similar ones.
So those realized losses can then offset capital gains within the portfolio or even from other sources like the sale of a home or a business. That's brilliant.
Exactly. And this tax loss harvesting can generate an additional return of 1 to 3% per year on average. We call this tax alpha. Essentially, it's like getting a bonus return just for managing your taxes strategically.
Okay, so there's the tax advantage. What else makes direct indexing stand out?
Customization is a major benefit. You can tailor your portfolio based on your risk tolerance, income needs, and even your personal values. For example, younger investors might opt for a growth tilt, while retirees could choose an income tilt. And if you have specific preferences, you can even exclude certain industries from your portfolio.
So, for example, if you're passionate about sustainability, you could exclude companies with, poor environmental records. That's pretty cool.
It's all about aligning your investments with your overall financial goals and values.
Now, is direct indexing right for everyone?
Not necessarily. It's not suitable for IRAs or qualified assets because the tax benefits only apply to taxable accounts. But it can be a great option for those with liquidity events, like a home sale or business sale, who want to offset capital gains. It's also beneficial for passive investors seeking those maximized after-tax returns, and even for trusts in high tax brackets.
That makes sense. Now, you mentioned something called a tax transition analysis. What's that all about?
Let's say you have investments with large unrealized gains that aren't performing as well as you'd like. A tax transition analysis helps you transition out of those investments while minimizing the tax impact. For example, you've held onto a stock for years and it's gone up significantly, but now you think it's time to sell. We can analyze your holdings, identify the closest matching index, and create different scenarios with varying levels of risk and potential tax implications.
So basically, it's a way to strategically manage your portfolio and minimize those tax headaches. It sounds like a powerful tool for anyone looking to, optimize their investments.
Precisely. It's all about making informed decisions and maximizing your financial outcomes.
Well, we've covered a lot of ground in this deep dive, from potential election impacts in promising sectors to tax-smart investing strategies. It's clear that while the future is always uncertain, there are proactive steps we can take to navigate the financial landscape.
And one final thought to keep in mind. While the market has been strong, potential risks, like an economic slowdown, are always on the horizon. It's crucial to stay informed, review your financial plans regularly, and consider how these insights can help you make informed decisions for your future.
Excellent advice. Thank you for sharing your expertise and insights with us today. This has been incredibly helpful.
It was my pleasure.
And for our listeners, stay tuned. We'll be right back after a short break to continue our exploration of the financial world. Welcome back. We've been talking all about election impacts and market outlooks and, smart tax strategies. But now let's dive into a fascinating aspect of finance that often gets overlooked, the human element.
That's right. We're talking about behavioral finance, which explores how our psychology, our emotions, even our biases, can influence our financial decisions.
Yeah, I think we've all been there, making an impulsive purchase, holding on to a losing investment for too long, or maybe even buying into the latest stock craze just because, everyone else is.
Exactly. We like to think we're rational beings, especially when it comes to money, but behavioral finance shows us that we're often far from it. We're susceptible to things like herd mentality, where we follow the crowd even if it goes against our best interests.
Like buying that meme stock everyone's talking about, even though you know nothing about the underlying company.
Precisely. Or consider loss aversion, that feeling that the pain of a loss is much stronger than the pleasure of an equivalent gain. That's why some people hold on to those losing investments, hoping they'll magically rebound, even when, logic says it's time to cut their losses.
Oh, that hits close to home. I've definitely been guilty of that. So how do we, overcome these behavioral biases? It feels like we're hardwired to make these mistakes.
Well, awareness is the first step. Just knowing these biases exist, recognizing them in ourselves, can make a huge difference.
So knowledge is power, but are there any practical strategies we can use to, let's say, outsmart our own brains?
Absolutely. Having a well-defined investment plan is crucial. Think of it as your financial roadmap. It keeps you focused on your long-term goals and helps you avoid making those impulsive, emotion-driven decisions.
Yeah, it's like having that GPS guide you, even when you're tempted to take a detour and you'll regret later.
Exactly. And don't underestimate the value of professional guidance. A financial advisor can provide an objective perspective, helping you navigate those tricky situations and avoid common pitfalls. They can also help you create that personalized investment plan and keep you, accountable to it.
It's like having a financial coach in your corner, helping you train your brain to make smarter money choices.
Precisely. Now, speaking of navigating tricky situations, let's shift gears and talk about another major force shaping the financial landscape. Artificial intelligence, or AI.
It's everywhere these days. It feels like every industry is being transformed by AI, from healthcare and finance to transportation and entertainment. It's exciting, but also a bit overwhelming, to be honest.
You're not alone. The AI revolution is upon us, and it's moving at an incredible pace. But as investors, it's crucial to understand how AI is impacting businesses and where the opportunities lie.
Okay, so let's start with the basics. How is AI changing the game for businesses?
One key area is automation. AI-powered systems can perform tasks that were once done by humans, often with greater efficiency and accuracy. Think about those chatbots we encounter on websites, or the algorithms that personalize our online shopping experiences.
And what about the impact on jobs? There's a lot of concern about, AI taking over human roles.
It's a valid concern, and one we need to address thoughtfully. While some jobs will inevitably be affected by automation, AI is also creating new opportunities in areas like data science, software development, and even AI ethics.
So it's not just about robots replacing humans. It's about adapting to a changing job market and acquiring, new skills.
Exactly. And this is where education and training programs become even more crucial. Now, beyond automation, AI is driving incredible innovation across industries. Think about personal medicine tailored to an individual's genetic makeup, or self-driving cars that could, revolutionize transportation.
Or even like AI-powered algorithms recommending movies or books based on our preferences. It's like having a personal assistant who knows us better than we know ourselves.
The possibilities are seemingly endless. And this innovation is creating new markets and, of course, new investment opportunities.
So for investors looking to capitalize on the AI revolution, where should they focus their attention?
One approach is to invest in companies that are at the forefront of AI development and implementation. Companies like, NVIDIA, which makes chips for AI applications, or Google, which is a leader in AI research and development, come to mind.
Okay, so those are the big players, but what about specific sectors being transformed by, AI?
Healthcare, finance, and transportation are all prime examples. Think about companies using AI to develop new drugs, improve financial services, or optimize logistics and delivery systems. There's potential for disruption and growth across the board.
And it's important to remember that AI is still in its, early stages, right? So while there's a lot of excitement, there's also a degree of uncertainty.
Absolutely. Investing in AI requires a long-term perspective and a willingness to embrace both the opportunities and the challenges. Diversification is key, as is thorough research before making any investment decisions.
Great advice. Now, before we move on, I'd be remiss if we didn't touch on the environmental, social, and governance factors, or ESG, that are playing an increasingly important role in, investment decisions.
You're right. ESG investing is no longer a niche concept. It's becoming mainstream, and for good reason. Investors are recognizing that financial returns are only part of the equation. They also want to align their investments with their values and make a positive impact on the world.
So it's about investing with both your head and your heart.
Precisely. ESG investing allows you to support companies committed to sustainability, social responsibility, and good governance practices.
Can you give us some examples of what that looks like in practice?
Absolutely. If you're passionate about climate change, you might invest in companies developing renewable energy solutions or those actively reducing their carbon footprint. If social justice is important to you, you might seek out companies with strong diversity and inclusion policies or those actively supporting underserved communities.
So it's about putting your money where your values are. Now, how can investors actually incorporate ESG factors into their portfolios? It seems like a daunting task.
It's becoming easier than ever. One option is to invest in ESG-focused mutual funds or exchange-traded funds or ETFs. These funds specifically target companies that meet certain ESG criteria, taking the guesswork out of it for you.
That sounds like a good option for someone who wants a simplified approach. Are there other ways to, get involved?
Absolutely. You can engage in shareholder activism, using your voting rights to influence corporate behavior. Many investors are actively advocating for policies that promote sustainability, social responsibility, and good governance practices within the, companies they invest in.
So you can actually use your voice and your vote to make a difference.
Exactly. And even if you don't want to go that route, you can simply choose to invest in companies that align with your values, even if they're not specifically labeled as ESG investments. It all starts with doing your research and making informed decisions that reflect your priorities.
Now, one question that often comes up is whether ESG investing comes at the expense of financial returns. Is it possible to do good and do well financially at the same time?
There's a growing body of evidence suggesting that ESG factors can actually enhance returns over the long term. Companies that prioritize sustainability, social responsibility, and good governance tend to be better managed, more resilient to risks, and better positioned to adapt to changing market dynamics.
So it's not a trade-off. It's potentially a win-win situation.
Exactly. Now, let's be realistic. There are challenges associated with ESG investing. One is the lack of standardized ESG metrics. Different rating agencies use different methodologies, which can make it difficult to, compare companies and funds apples to apples.
So it's important to do your own research and not rely solely on third-party ratings.
Absolutely. And keep in mind that ESG ratings can be subjective and influenced by the values of the, rating agencies themselves. It's a complex landscape, but the key is to be informed and make decisions that align with your personal values and financial goals.
ESG investing is clearly gaining momentum, and it's an exciting development. It represents a powerful opportunity to align your investments with your values and contribute to a more sustainable and just world.
I couldn't agree more. It's about using your financial power to make a positive impact while also, seeking financial returns.
Well, we've covered a lot of ground today, from the nuances of behavioral finance to the transformative power of AI and the growing importance of ESG investing. It's clear that the world of finance is constantly evolving, and staying informed is more crucial than ever.
You've hit the nail on the head. Knowledge is power. And by staying curious and engaged, you can navigate the complexities of the financial world and create a brighter financial future for yourself and, those you care about.
And speaking of knowledge and empowerment, let's move on to another powerful concept that can help us build long-term wealth: compound growth. We've talked about a lot of complex, even intimidating financial topics today.
Yeah, from elections and interest rates to the nuances of AI and ESG investing.
It's enough to make anyone's head spin. But amidst all that complexity, there's one principle that's both incredibly powerful and refreshingly simple: compound growth.
Yeah. It's often called the eighth wonder of the world, and for good reason.
Okay, I'm intrigued. Break it down for us. What's so, magical about compound growth?
Imagine a snowball rolling down a hill, right? It starts small, but as it rolls, it picks up more snow, growing larger and larger.
Okay, I can picture that, but how does that relate to, our money?
Think of it this way. When you invest, your money earns interest. Then that interest earns interest, and so on. It's like a chain reaction of wealth creation. It's the snowball effect in action.
So even small, consistent investments can grow exponentially over time thanks to the magic of compounding.
Exactly. Let's say you invest $100 a month and earn an average annual return of 7%. After 30 years, you'd have over $100,000.
Wait, seriously, that's from just $100 a month? That's incredible. It really highlights how time is your greatest ally when it comes to investing.
Absolutely. The earlier you start, the more time your money has to compound and grow. It's like planting a tree. The sooner you plant it, the more time it has to, grow into a mighty oak.
So what's the key takeaway for our listeners? What's the one piece of advice you would give, especially to younger investors just starting out?
Start investing early. Even if it's with, small amounts. Consistency is key. Don't get discouraged if you can't invest a lot right away. What matters is developing the habit and letting time and compound growth work their magic.
And don't forget to reinvest those earnings, right? That's how you really accelerate the snowball effect.
Exactly. Reinvesting your earnings allows those gains to compound even faster, supercharging your returns over time.
This has been an incredible deep dive. We've covered so much ground, from the anxieties of Election Day to exploring potential opportunities and, actionable strategies to empower our listeners.
It's been a pleasure sharing these insights. I hope our listeners feel more informed and confident in navigating the complexities of the financial world.
We've emphasized the importance of being proactive, planning for taxes, understanding your own behavioral biases, and staying ahead of the curve on trends like AI and ESG investing.
And of course, never underestimate the power of compound growth. Start early, stay consistent, and let time work its magic.
Well said. Thank you so much for joining us today.
It was my pleasure.
And to our listeners, thank you for tuning into the deep dive. We hope you found this journey through the world of finance informative and inspiring. Until next time, stay curious and, keep learning.
2FC 90.